Financial economics is the branch of economics characterized by a concentration on monetary activities, in which money of one type or another is likely to appear on both sides of a trade. Its concern is thus the interrelation of financial variables, such as prices, interest rates and shares, as opposed to those concerning the real economy. It has two main areas of focus: asset pricing and corporate finance, the first being the perspective of providers of capital and the second of users of capital. The subject is concerned with the allocation and deployment of economic resources, both spatially and across time, in an uncertain environment. It therefore centers on decision-making under uncertainty in the context of the financial markets, and the resultant economic and financial models and principles, and is concerned with deriving testable or policy implications from acceptable assumptions. It is built on the foundations of microeconomics and decision theory. Financial econometrics is the branch of financial economics that uses econometric techniques to parameterize these relationships. Mathematical finance is related in that it will derive and extend the mathematical or numerical models suggested by financial economics. Note though that the emphasis there is mathematical consistency, as opposed to compatibility with economic theory. Financial economics is usually taught at the postgraduate level. See Master of Financial Economics. Recently, specialist undergraduate degrees are offered in the discipline. Note that this article provides an overview and survey of the field. For derivations and more technical discussion, see the specific articles linked. Underlying economics. As above, the discipline essentially explores how rational investors would apply decision theory to the problem of investment. The subject is thus built on the foundations of microeconomics and decision theory, and derives several key results for the application of decision-making under uncertainty to the financial markets. Present value, expectation and utility. Underlying all of financial economics are the concepts of present value and expectation. Calculating their present value allows the decision-maker to aggregate the cash flows to be produced by the asset in the future to a single value at the date in question, and to thus more readily compare two opportunities. This concept is therefore the starting point for financial decision-making. Its history is correspondingly early. It was developed in a book on compound interest by Richard Witt, and these ideas were further developed by Johann de Witt and Edmund Halley. An immediate extension is to then combine probabilities with present value, leading to the expected value criterion, which sets asset value as a function of the sizes of the expected payouts and the probabilities of their occurrence. These ideas originate with Blaise Pascal and Pierre de Fermat. This decision method, however, fails to consider risk aversion. In other words, since individuals receive greater utility from an extra dollar when they are poor and less utility when comparatively rich, the approach is to therefore adjust the weight assigned to the various outcomes correspondingly. Choice under uncertainty here may then be characterized as the maximization of expected utility. More formally, the resulting expected utility hypothesis states that, if certain axioms are satisfied, the subjective value associated with a gamble by an individual is that individual's statistical expectation of the valuations of the outcomes of that gamble. The impetus for these ideas arise from various inconsistencies observed under the expected value framework, such as the St. Petersburg paradox. The development here originally due to Daniel Bernoulli, and later formalized by John von Neumann and Oscar Morgenstern. Arbitrage-free pricing and equilibrium. The concepts of arbitrage-free, rational, pricing and equilibrium are then coupled with the above to derive classical, financial economics. Rational pricing is the assumption in financial economics that asset prices will reflect the arbitrage-free price of the asset, as any deviation from this price will be arbitraged away. This assumption is useful in pricing fixed income securities, particularly bonds, and is fundamental to the pricing of derivative instruments. Economic equilibrium is, in general, a state where economic forces such as supply and demand are balanced, and in the absence of external influences these equilibrium values of economic variables will not change. General equilibrium deals with the behavior of supply, demand, and prices in a whole economy with several or many interacting markets. By seeking to prove that a set of prices exists that will result in an overall equilibrium, the two concepts are linked as follows. Where market prices do not allow for profitable arbitrage, i.e., comprise an arbitrage-free market, so these prices are also said to constitute an arbitrage equilibrium. Intuitively, this may be seen by considering that where an arbitrage opportunity does exist, then prices can be expected to change, and are, therefore, not in equilibrium. An arbitrage equilibrium is thus a precondition for a general economic equilibrium. The immediate, and formal, extension of this idea, the fundamental theorem of asset pricing, shows that under the above conditions we may conduct financial decisioning, applying a risk-neutral probability measure, and further, the expected return of any security equals the riskless return plus an adjustment for risk, i.e., a risk premium. All pricing models are then essentially a variant on this, given specific assumptions and/or conditions. Staked prices with the above relationship established, the further specialized Arrow-Debu model may be derived. This important result suggests that, under certain economic conditions, there must be a set of prices such that aggregate supplies will equal aggregate demands for every commodity in the economy. The analysis here is often undertaken assuming a representative agent. The Arrow-Debu model applies to economies with maximally complete markets, in which there exists a market for every time period and forward prices for every commodity at all time periods. A direct extension, then, is the concept of a state price security, a contract that agrees to pay 1 unit of a numeraire if a particular state occurs at a particular time in the future and pays 0 numeraire in all the other states. The price of this security is the state price of this particular state of the world. Correspondingly, the state price vector is the vector of state prices for all states. Staked prices find immediate application in financial economics, as will be seen below. For example, any derivatives contract whose settlement value is a function of an underlying whose value is uncertain at contract date can be decomposed as a linear combination of its Arrow-Debu securities, and thus as a weighted sum of its state prices. Analogously, for a continuous random variable indicating a continuum of possible states, the value is found by integrating over the state price density. See stochastic discount factor. These concepts are extended to martingale pricing and the related risk-neutral measure. Resultant models. Applying the above economic concepts, we may then derive various economic and financial models and principles. As above, the two usual areas of focus are asset pricing and corporate finance, the first being the perspective of providers of capital, the second of users of capital. Here, and for all other financial economics models, the questions addressed are typically framed in terms of time, uncertainty, options, and information, as will be seen below. Time. Money now is traded for money in the future. Uncertainty. The amount of money to be transferred in the future is uncertain. Options. One party to the transaction can make a decision at a later time that will affect subsequent transfers of money. Information. Knowledge of the future can reduce, or possibly eliminate, the uncertainty associated with future monetary value. Applying this framework, with the above concepts, leads to the required models. This derivation begins with the assumption of no uncertainty, and is then expanded to incorporate the other considerations. Certainty. A starting point here is investment under certainty. The Fisher separation theorem asserts that the objective of a corporation will be the maximization of its present value, regardless of the preferences of its shareholders. Related is the Modigliani-Miller theorem, which shows that, under certain conditions, the value of a firm is unaffected by how that firm is financed, and depends neither on its dividend policy nor its decision to raise capital by issuing stock or selling debt. The proof here proceeds using arbitrage arguments, and acts as a benchmark for evaluating the effects of factors outside the model that do affect value. The mechanism for determining value is provided by the theory of investment value, which proposes that the value of an asset should be calculated using evaluation by the rule of present worth. Thus, for a common stock, the intrinsic, long-term worth is the present value of its future net cash flows, in the form of dividends. What remains to be determined is the appropriate discount rate. Later developments show that, rationally, i.e., in the formal sense, the appropriate discount rate here will depend on the asset's riskiness relative to the overall market, as opposed to its owner's preferences. See below. It will be noted that these certainty theorems are all commonly employed under corporate finance. Uncertainty is the focus of asset pricing models, as follows. Uncertainty for choice under uncertainty. The twin assumptions of rationality and market efficiency lead to modern portfolio theory with its capital asset pricing model, an equilibrium-based result, and to the Black-Scholes-Merton theory for option pricing, an arbitrage-free result. But personally, as a financial economics employee, salary is bound to a decrease if the resources distributed by the company has a decrease in the demand for the resources on the market less than certain greater than briefly, and intuitively, and consistent with arbitrage-free pricing and the equilibrium above. The linkage is as follows. If prices of financial assets are correct, i.e., efficient, then deviations from these values could not last for long. Correspondingly, prices would be expected to change on the arrival of new information. The random walk hypothesis. Under these conditions, investors can then be assumed to act rationally. Their investment decision must be calculated or a loss is sure to follow. Also, where an arbitrage opportunity presents itself, then investors will exploit it, reinforcing this equilibrium. Here, as under the certainty case above, the specific assumption as to pricing is that prices are calculated as the present value of expected future dividends, as based on currently available information. What is required though is a theory for determining the appropriate discount rate given this uncertainty. This is provided by the MPT and its CAPM. Relatedly, rationality, in the sense of arbitrage exploitation, gives rise to Black-Scholes option values here ultimately consistent with the CAPM. In general, then, while portfolio theory studies how investors should balance risk and return when investing in many assets or securities, the CAPM is more focused, describing how, in equilibrium, markets set the prices of assets in relation to how risky they are. The theory demonstrates that if one can construct an efficient frontier, then mean variance efficient portfolios can be formed simply as a combination of holdings of the risk-free asset and the market portfolio, with the combinations here plotting as the capital market line, or CML. Then given this CML, the theory shows that the expected return on risky securities will be independent of the investor's utility function, and solely determined by their covariance with aggregate risk. As seen in the formula aside, this result is consistent with the preceding, equaling the riskless return plus an adjustment for risk. Note an important implication here. Under the assumptions of MPT, an asset may be priced without reference to the investor's level of risk aversion, thus providing a readily determined discount rate for corporate finance decision-makers as above. Black-Scholes provides a mathematical model of a financial market containing derivative instruments, and the resultant formula for the price of European-styled options. The Black-Scholes equation is a partial differential equation describing the price of the option over time. The key financial insight behind the equation is that one can perfectly hedge the option by buying and selling the underlying asset in just the right way, and consequently eliminate risk, absenting the risk adjustment from the pricing. This hedge, in turn, implies that there is only one right price, in an arbitrage-free sense, for the option. Then, assuming log-normal, geometric Brownian motion, we may derive the Black-Scholes option pricing formula, which will return the correct option price. This pricing is without reference to the share's expected return, and hence entails risk neutrality. Relatedly, therefore, the pricing formula may also be derived directly via risk-neutral expectation. See Brownian model of financial markets. As mentioned, it can be shown that the two models are consistent. Then, as is to be expected, classical financial economics is thus unified. Here, the Black-Scholes equation may alternatively be derived from the CAPM, and the price obtained from the Black-Scholes model is thus consistent with the expected return from the CAPM. The Black-Scholes theory, although built on arbitrage-free pricing, is therefore consistent with the equilibrium-based capital asset pricing. Both models, in turn, are ultimately consistent with the Arrow-Debreu theory, and may be derived via state pricing, further explaining, and if required demonstrating, this unity. Extensions. More recent work further generalizes and/or extends these models. Multi-factor models such as the Farmer-French 3-factor model and the Carhart 4-factor model propose factors other than market return as relevant in pricing. The intertemporal CAPM, Black-Litterman model, and arbitrage pricing theory similarly extend modern portfolio theory. The single index model is a more simple asset pricing model than the CAPM. It assumes only a correlation between security and market returns, without other economic assumptions. It is useful in that it simplifies the estimation of correlation between securities, significantly reducing the inputs for building the correlation matrix required for portfolio optimization. See also Postmodern portfolio theory, mathematical finance # risk and portfolio management. The P-world. As regards derivative pricing, the binomial options pricing model provides a discretized version of Black-Scholes, useful for the valuation of American-styled options. Discretized models of this type are built using state prices, while exotic derivatives, although modeled in continuous time by Monte Carlo methods for option pricing, are also priced using risk-neutral expected value. Various other numeric techniques have also been developed. The theoretical framework too has been extended such that martingale pricing is now the standard approach. Since the work of Breeden and Listenberger in 1978, a large number of researchers have used options to extract Arrow-Debreu prices for a variety of applications in financial economics. Developments relating to complexities in return and/or volatility are discussed below. See also mathematical finance # derivatives pricing. The Q-world. Derivative models for various other underlyings and applications have also been developed, all departing from the same logic. Beginning with Oldrich-Vasicek, various short-rate models, as well as the HJM and BGM forward rate-based techniques, allow for an extension to fixed income and interest rate derivatives. Real options valuation allows that option holders can influence the options underlying. Models for employee stock option valuation explicitly assume non-rationality on the part of option holders. Credit derivatives allow that payment obligations, delivery requirements might not be honored. Exotic derivatives are now routinely valued. Note that real options theory is also an extension of corporate finance theory. Asset valuation and decisioning here no longer need assume certainty. Relatedly, as discussed above, Monte Carlo methods in finance, introduced by David B. Hertz in 1964, allow financial analysts to construct stochastic or probabilistic corporate finance models. As opposed to the traditional static and deterministic models, see corporate finance #quantifying uncertainty. Other extensions here include agency theory. Clean surplus accounting and the related residual income valuation provide a model that returns price as a function of earnings, expected returns, and change in book value, as opposed to dividends. This approach, to some extent, arises due to the implicit contradiction of seeing value as a function of dividends, while also holding that dividend policy cannot influence value per Modigliani and Miller's irrelevance principle. See dividend policy #irrelevance of dividend policy.